Welcome back to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here. Today will be, pardon me, today will be Friday, the 26th of September 2025. So very good morning to all. Before we kickstart today's Daily Dose of Market Insights, which has a lot of interesting things to cover, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's full suite of daily dose of market insights that cover all the 12 intraday technical analysis of the broad-based asset classes that we cover on a daily basis, let's have a quick look at what has taken shape yesterday in terms of news flow, economic data releases, and as well as in today's Asia session as well for this bunch of economic releases and all economic data. And most importantly, their impact on the intraday movement on those broad-based cross-asset classes that we cover on a daily basis. So yesterday's move was very, very volatile in the US session, all because of a rather surprisingly revised upward Q2 GDP growth in the US. So what do I mean by this? So let's look at the economic calendar. All right, go to the economic calendar. Okay, so yesterday is Thursday. Okay, so it's over here. One second. Where is this? Yeah, this is the one. All right. So yesterday at 8:30 p.m. Singapore time, we have the release of this finalized Q2 GDP growth rate. All right. So market is actually expecting a 3.3% increase over here, but it came in way above expectation of market is expecting 3.3% increase, but it came in way above expectation at 3.8%. So this burst up in this finalized Q2 GDP growth rate in the US that came in way above market expectation, pardon me, reduces the Fed funds rate bets for the last FOMC meeting for this year. So still recall that prior to the FOMC meeting last week, there's a lot of increase in the bets being placed on the Fed funds futures market, calling for a much more dovish Fed going forward in the remaining months of 2025 and as well as in 2026, where market participants in the Fed funds futures market are looking out for 3 interest rate cuts for 2025 and 3 to 4 interest rate cuts in 2026. So that causes the dollar to actually did that softness or that bearish trend before the FOMC meeting. Then after the FOMC meeting, Fed Chair press conference delivered a much more less dovish speech over here that causes the dollar setback story or the dollar bearish trend to reverse some portion of it before yesterday's release of that GDP growth rate data. So prior to the release of GDP growth rate data, the dollar softness came back on Tuesday and Wednesday, but this dollar softness has started to revise more on towards the upside. Later I'll share with the dollar index charts, all because of right now the Fed funds futures traders have started to reduce their Fed funds rate cut bets going forward into 2025 in the last 3 more months of before 2025 ends, and also into 2026. All right, so how do I see that? By looking at the Fed funds futures compilation by the CME Fed Watch tool over here, where they calculate the odds of how much the Fed funds futures traders are placing on whether the Fed will hold, cut, or increase interest rate. So we know that the first interest rate cut has already been done and dusted in last week. Okay, so market participants now are looking forward in the next meeting excuse me, on the 29th of October and the 10th of December. So the 29th October meeting is still rather higher. Okay, give me a minute over here. Let me go to the 29th of October. Okay, so the 29th October meeting is still rather high. above 70%. So at 88% chance that the Fed funds futures traders are looking for another 25 basis point cut on the 29th of October meeting. All right, so to bring it down to 3.75% to 4%. So current Fed funds rate is at 4% to 4.25%. So after yesterday's stronger than expected Q2 finalized GDP growth rate for the US, that only reduces by I think what 4 basis point over here, because prior to the release of the US GDP growth rate data yesterday, it was at 92%. So now it dropped to 88%. All right. So that's about 3 to 4 basis point difference only. But what's interesting over here is that if I go to the aggregator tab to take into look of the December meeting, all right, the last meeting of the year, the 12th of the 10th of December, pardon me, that has dropped down to almost a coin flip of 58%. All right. So current rate is at 4%. Market expecting another cut of 25 basis point on the 29th of October meeting. But before yesterday, the so-called the third cut of the year, all right, the first cut's already done. Second cut will be on the 29th of October. So the previous anticipated third cut of the year prior to yesterday was rather high, as around 70% plus. Those who actually record in my previous daily dose where I share with you guys. So that has now dropped to almost a coin flip to about 58%. So because of this reduction of the future next FOMC meeting rate cut bets, causes the dollar strength to spike up yesterday. And most importantly, what we could see over here is that next year, previously market participants are in the Fed funds futures market again are looking for 3 cuts. That cut now has been reduced to 2 cuts so far. All right. So after that 58% chance potential cut on the 10th of December of 2025 to bring it down to 3.5% to 3.75%, that market is expecting the Fed to hold on 28th of January next year, to hold again on the 18th of March next year, and only potentially cut on the 17th of June next year at 2026. All right, that's 93% chance. Then thereafter, it will potentially do another second cut in 2026, either on the 16th of September FOMC meeting 2026, or on the 28th of either on the 16th of September or 28th of October 2026 FOMC meeting. Give me a minute, sorry, I need to take a sip of water because of my sore throat. Right. Man, the weather is getting bad for this sore throat. All right. So what I try to actually explain to you guys is that the initial rather high dovish expectation being placed by the Fed funds futures traders has been gradually reduced after yesterday's surprisingly upside revision of that Q2 finalized GDP growth rate in the US, causing the the US dollar to actually spike up yesterday. So if you look at the US dollar, the dollar rose across the board. So this is the 5-day rolling performance of the US dollar against other major currency as of we are speaking right now. And on a intraday basis, on the 1-day basis, we start to see the dollar strength doing a bit of pullback ahead of today's key risk event, which is the release of the PCE inflation data that is out later today. Later, I'll share with you guys more about the expectation, okay, towards the end of that daily dose. So with this spike up, with this reduction in bets done by the Fed funds futures traders, that means they're expecting the Fed now to be less dovish than before. That causes the dollar index to spike up yesterday above the 20-day and above the 50-day moving average. Right, so over here, last week managed to survive the all-important 97.3 long-term circular support on the US dollar index. Now it bounces back up yesterday, has a daily close with a strong, rather bullish Marabuzu candlestick. Not 100%, about 90%, because there's still a bit of upper shadow, but it did have a clear daily close above the 50-day and above the 20-day moving average. So right now, potentially the dollar index may see a bit of residual push up back up towards the next resistance at 98.95. So this 98.95, very important, is actually close to the candlestick high of this black Marabuzu candlestick on the 22nd of August this year. Okay, so what happened on 22nd of August? It was a Friday. That was actually the Fed chair dovish speech during the Jackson Hole Symposium, where he starts to change his stance from a wait and see to a much more dovish stance, where he expressed concern about the softening of the US labor market. So this is a rather psychological event, and also in terms of next intermediate resistance level is the 98.95. Above this 90.95 potentially takes us up to 110, 155. So this 110 is very important. So this is a black Marubozu candlestick high on the 4th of August. So still recall what's 4th of August. So 4th of August was also a Friday, 1st of August, not 4th of August. 1st of August this year is a Friday. So that was actually the shocking release of that rather weak NFP print that shock market that causes the dollar earlier dollar rally to actually give back and tumbled in the last we call it 4 weeks or 4+ weeks. And so all right, over here. So net overall, right, this dollar, because of yesterday's strong bounce in the dollar, there could be some form of dollar strength that still continue because of this unwinding of that earlier amount of dollar shorts that are rather high based on the those futures contract that I shared with you guys earlier on at the part of this week, the net short position on the US dollar index. So there could be some kind of dollar shorts getting unwind going forward. So at least in the short term, we may see some US dollar pair shaping the kind of mean reversion rebound that may take shape because of this dollar adjustment due to dollar net extreme net short adjustment due to yesterday's surprise surprise release of that finalized Q2 GDP growth data that came in way above expectation at 3.8%. Now, with that also created a shock to the US stock market as well because of the lack of liquidity. So the US stock market in the last 4 weeks or so has been rallying due to hopes of more liquidity being added to the market, also supporting this rather stretch rich highly valued AI team play stocks, especially Nvidia. We have Oracle coming in as well as Intel right now, especially the US semiconductor stocks that is riding this bullish, that is on the forefront or the market leader in this ongoing bullish trend in the US stock market since the start of this year and since 3 years ago. But what's interesting over here is that yesterday's sell-off in the major US stock indices managed to found a minor swing low at the 2 a.m. mark Singapore time before shaping that minor V-shaped recovery. So initially at the first session of the US session, the S&P 500 actually plunges close to more than 1%, all right, similar to the Nasdaq 100 as well. But coming towards the end of the US market in the last 2 hours, they managed to shape that minor V-shaped recovery and trim up their losses. So the SPX managed to close at negative 0.5%, the Nasdaq negative 0.43%, the Dow Jones negative 0.4%. The weakest is still the Russell 2000, down negative 1% because they actually much more dovish Fed going forward because the Russell 2000, they do not have very strong net cash flow on the average. So to maintain their business operation, they tends to actually rely more on leverage or gearing. So given the fact that if the Fed funds futures traders start to reduce their Fed rate cut bets, that could impact significantly on the Russell 2000. So that actually explained the Russell 2000 underperformance yesterday, which is down by negative 1%. So let me share with the cash stock index of the S&P 500 over here. Okay, so this is the S&P 500. So yesterday, upon because it came in of the GDP data of US came in before the start of the US session yesterday, which is at 8:30 p.m. Singapore time. US session officially start, the cash trading session start at 9:30 p.m. Singapore time. So there was actually a sharp gap down yesterday on the S&P 500. So overall, it actually closed. It had an intraday loss at maximum drawdown of negative 1%, 1.04%. And what's interesting over here is that after that, it managed to reverse, and the reversal came right exactly at the 20-day moving average and form a bullish dragonfly doji candlestick yesterday. So later I'll share with you the technical chart on the CFD index, all right, the SPX CFD index. Okay, so that's for the session yesterday. over here. And also in today's Asia session, early Asia session, we have this release of this tariff tantrum again. So Trump tweeted over his social media. Nothing official yet came from the US White House official press, but usually once Trump tweeted over social media, the official statement will come out from the US White House. But yesterday, the official statement didn't came out. So Trump tweeted yesterday, I think it's after the close of the US session early, or way very early in Asia session. So he tweeted over his so-called his social media, stating that from 1st of August, 1st of October, which is next month, we'll be imposing 100% tariff on any branded or patent pharmaceutical product, unless the company is building their pharmaceutical manufacturing plant in the US, America, Trump wrote. Therefore, there'll be no tariff on these pharmaceutical products if construction has started over here. So he also mentioned yesterday in the tweets that there are also other product related tweets. Imported heavy trucks will be subjected to 25% tariff. Kitchen cabinets and bathroom vanities, means bathroom, your toilet bowl or sink, will be charged at a 50% tariff. And also some furniture imports will be taxed at 30%. So there's a slew of so-called sector or product-based tariff that is excluding from the scope of those reciprocal tariffs that has been settled about 4 weeks ago. So that actually created a negative feedback loop into the Asia stock market. All right, so lots of Asia related pharmaceutical stocks actually came down, traded down by more than 1% because of this fear of Trump's tantrum, invoking 100% tariff of pharmaceutical product heading into the US unless they start building it over here. So market will be looking for the official press release later today at the start of the US session, perhaps, because this was tweeted in the close, after the close of the US session, way early in Asia time today. So what we could see right now over here is that the Asia stock market, the Nikkei, is down by a fair bit, but not that scary of Hang Seng Index and the Hang Seng Tech. So the Hang Seng Index is down by negative 0.8%. The Hang Seng Tech is down by negative 1.1%. So that also came in on the backdrop of this week, the Hong Kong stock, especially the Hong Kong Hang Seng Tech Index, where the China big tech stocks are being concentrated, especially the likes of Alibaba, Baidu, SMIC. They have been rallying very strongly since the start of this week due to Alibaba big push on this AI AI investment that Alibaba has assigned to their company. So very nature, any macro shock that came in this morning created a much more forceful sell-off in the Hang Seng Tech index over here. And the rest of the Asia, the China A share stocks is not too bad. The CSI 300, which consists of both the Shenzhen and Shanghai Stock Exchange, down marginally by negative 0.2% over here. And going down to Asia, Southeast Asia, I would say our Singapore STI managed to stage a modest gain at 0.15%, and the ASX 200, which is the Australia's benchmark stock index, managed to also gain marginally as well as 0.2%. So net overall, there is no clear sell-off or risk-off environment in the global stock market, despite the fact that the Fed cuts rate, the probability of the Fed rate cuts has been slightly reduced yesterday after the rather strong surprise finalized Q2 GDP growth for US that came in above market expectation. All right, so with that, now let us now jump straight into the intraday technical outlook. All right, starting with the FX market. Okay, so before that, let me expand my screen. All right, so let me expand my screen so that you guys could have a better view of the charts over here. Okay, so I think the screen is expanded. Good. Okay, so let's start with the FX market first, very quickly. Okay, starting with the euro dollar. All right, over here. So the euro dollar plunges below our short-term pivotal support level, which is the 117.30 level, and also broke below the 50-day moving average. So what we could see now, the euro dollar is potentially doing this kind of sideways rangy configuration after hitting a 4-year high before on the onset of the FOMC meeting last week at 119.10, where it can maintain the momentum and starts to trade sideways. So very likely it may retest this sideways lower limit range support level that was formed at early August this year. All right, early August this year at this region. So it could potentially be kind of sideways range. It could be either a triangle formation or a kind of a rectangle formation. All right, but the clearly over here is that there's this medium-term ascending trend line, which I drew from the low of 3rd of February this year, that is still supporting at 116.15, 115.80. All right, so this all the way down to this September, February. All right, okay, this February 2025 ascending trend line. Now back to our key levels to watch out for today. Okay, over here, let me stretch it out. Okay, so what I could see is that number one, some technical elements to highlight is for sure the bias now is more skewed towards the downside rather than upside because of, but we know that price oscillate over here, it oscillates. So what we could see over here is that potentially there's this minor intraday downtrend that has been formed. Okay, but looking at this channel here. Okay, so this is a channel. Okay, so this is the kind of a intraday minor downtrend phase over here within that sideways complex range configuration that is still in place since early August this year. All right, so now the lower limit of this minor ascending channel is at 116.15, then 115.80 as well, which is this minor swing low area of 23rd of August and 28th of August, and also the 1.236 Fibo extension taken from the previous 4-year high of 18th of September this year. So right now, price action has tumbled very steeply yesterday, and because the way it tumbled very steeply, the RSI has hit the oversold level and now exit from the oversold level. So potentially because of this extreme intraday oversold level that got being exited right now by depicting from the observation for the hourly RSI. That means going forward, right now there could be a minor bounce heading into the European session before the release of the core PCE price index for US today. Later I'll share what's the timing. So potentially there could be a minor bounce taking shape. So minor bounce resistance level to watch will be 116, this level here. Oops, where is it? Okay, the 117 figure level. Then my pivotal resistance, I'll place it at 117.30, which is the yesterday's pivotal support, now turns into a pivotal resistance level, and also confluence with the 20-day moving average as well. So i.e., that means I'll be looking for any bounces to fade this strength of these bounces and flip it into a bearish bias for today, given that the trend bias is more on the downside. So it's more like a bounce within a minor intraday downtrend that is still taking shape right now. Okay, so fade any potential bounces using 117.30. So as long as this bounce didn't surpass above 117.30 pivotal resistance that I have on the euro dollar, the next near-term support level to watch in this bearish biasness intraday bearish biasness will be at 117.50 followed by 115.80. Only a bullish breakout above 117.30 will invalidate today's bearish view to see a squeeze up for the boost to come back into the picture again, at least in the first step, to test the next intermediate resistance at 118.20, followed by 118.60 on the intraday basis. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar was one of the worst hit yesterday as it broke below this former medium-term ascending trend line that I drew from the low of 13th of January 2025. All right, so given the fact that now it managed to stop at the 133.30 minor swing low of 3rd of September, right, at 133.30, and also the hourly RSI has exited from a oversold region that was hit yesterday during the middle part of the US session. So with this exiting from the oversold level on the hourly RSI, there could be a minor bounce as well taking shape on the sterling dollar before another bearish leg takes shape around the pullback area of this former medium-term ascending trendline support now turns into a critical intraday resistance in order for the bulls to gain control. All right, so it will be a zone at one in order for the bears to gain control. Pardon me, bit tongue twisting. At 134.40, 134.65, we saw confluence with the 50-day moving average that was taken down yesterday as well. So flip to a bearish bias in any potential bounces that could take shape. First bounce level to watch out for will be at 133.95, maximum 134.40, 134.46, 134.40, 134.65. So that will be my short-term pivotal resistance on the sterling pound. Thereafter, potentially there could be another round of bearish intraday impulsive downward sequence unfolding, breaking below the 133.30 intermediate support level, exposing 132.65, followed by 132.10. So 132.65 is the minor swing low area of 4th of August and 5th of August, and 132.10 maximum will be at the congestion area around the 1st of August. Only a bullish breakout above 134.65 that would invalidate today's bearish view to see the return of the bulls. So in the first step, the next resistance level to look out for will be at the 20-day move, around the 20-day moving average at 135, 135.35 over here. So in fact, it's a tight zone. Okay, so if you take into account the 20-day moving average, this level here, okay, so it's 135.10, 135.30. 35, 35. Right, so it's rather something like a tight zone over here, 35.10 slash 135.35. Above it, potentially seek out 135.95 next on the intraday basis. All right, so that's for the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar also plunges as well yesterday on the intraday basis and broke below our 20-day moving average, which was previously our pivotal support level at around the at the 65.80 level. What's interesting over here is that we now start to see the RSI hitting the oversold level during yesterday's US session sell-off, and in today's Asia session, it exited from the oversold level, and prior exiting from the oversold level, it shaped a bullish divergence. All right, so because of this bullish divergence that's being seen on the hourly RSI, I will flip to a neutrality stance for today instead, rather than to be outright bearish. So neutral between 65.80 and 65.30 on the Aussie dollar for today. So unless we have a sudden bearish breakdown below 65.30, so today I'll be neutral between 65.30 and 65.80. So unless we have a direct bearish break below 65.30, then the bias will shift to the bearish side on the intraday basis, exposing the minor swing low area of 3rd of September, 4th of September, and as well as 2nd of September at 65 figure slash 64.85. It starts to integrate back below this expanding wedge lower limit that is still in place since 24th of April this year. All right, still recall that it's still trading within this expanding wedge configuration since 24th of April this year. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen also squeezed up yesterday above our short-term pivotal resistance level at the 148.95 level, and so go above the 200-day moving average. And right now, it's actually testing the medium-term pivotal resistance at 149.90. This is the daily chart of the dollar yen, which is also the upper limit of this ongoing ascending wedge range configuration that has been in place since 22nd of April over here. All right, so very interesting. The Aussie dollar is in the expanding wedge, whilst the dollar yen is in the ascending wedge configuration. Okay, so overall, it still is a kind of a complex medium-term range configuration that these two pair are trading. So on a daily basis, if you look at the dollar yen over here, this will be the 149.90 level, the medium-term pivotal resistance level. But what's interesting over here is that during today's Asia session, it exit from an overbought level on the hourly RSI, and before exiting from overbought, it flashed out a bearish divergence, a lower high over here. So with this bearish divergence, right at the pivotal resistance level, medium-term pivotal resistance level at 149.90. So with that, I will flip to a neutrality stance on the dollar yen for today. So neutral between 149.90 and 148.95 slash 148.75, which was yesterday's pivotal short-term pivotal resistance, now turns into a critical short-term pullback support, which is the minor swing high area of 2nd of September and 3rd of September, where and as well as 22nd of August, where previously bears were rejected, and yesterday we see a squeeze up above this level, where I believe that a lot of net shorts are position are being unwind on the dollar yen because of that squeeze up. So this will be a rather critical area for the players to watch out for. So if this level can't hold, that means it could potentially invite fresh new shorts position coming into the dollar yen again. All right, so neutral for now between 149.90 and 148.95, 148.75. So that's for the dollar yen. Next up will be the major stock indices, starting with the Hong Kong 33, that's representing the Hang Seng Index. So before we go for our, yesterday I go for a break for a medical appointment. We do have a bullish bias on the Hong Kong 33. So level still remains the same because it's still trading inside our level. It didn't break out or break down. So previously we have a first support level to look out for will be at 20,690, which correspond to the rising 20-day moving average, and slightly below it will be my pivotal support level at 25,860. So this 25,860 is very important. Was this former ascending triangle range configuration that was previously in place since 24th of July all the way down to 5th of September, and it managed to do a bullish breakout on the 9th of September, did a pullback on the 11th of September, then before staging that a push up towards the 4-year plus high of 26,940, then before that pullback take shape. Exposed FOMC. So what we could see over here is that levels still remain the same. Price action going to trade above the rising 20-day moving average. So I'll be still using this critical level, the former ascending triangle range resistance now turns into a critical pullback support level at 25,860. So this will be still with my pivotal support. Still looking at this area here for it to seek out a potential minor bullish reversal move. Resistance level to watch for sure will be the rejection level yesterday at 26,650, and also got rejected on last Friday at 26,650 level. So this level got to break out in order for the bulls to gain more traction or to increase the odds of the fresh minor impulsive bullish up move sequence to kickstart, revisiting 26,940 in the first step. Thereafter, then followed by 27,125, 27,128. So for now, these are the key levels to watch. Still maintains a bullish biasness above 25,860, but first resistance level will be at 26,650 for now. However, if we start to see a bearish breakdown below 25,860, today bullish view will be negated to see another round of minor corrective decline extending further to the downside to retest the rising 50-day moving average and also the medium-term ascending channel from the low of 2nd of June 2025 low at 25,500. That's for the Hong Kong 33 representing the Hang Seng Index. Next up will be the Japan 225 representing the Nikkei 225. So the Japan 225 also continues to trade in a sideways range configuration, and this sideways range configuration after the initial sell off last Friday exposed BOJ seems to be now forming a minor ascending triangle range configuration. Why? Similar high at the 45,960 level and higher low, this low, higher than this, slightly higher than this, almost slightly higher than this low as well, and higher this low. So this potentially could be a minor ascending triangle range configuration that is forming. So no change given that it's still within this range. Pivotal support will be still at the 45,000 psychological level, which I have seen this week. So 45,000 short-term pivotal support level, maintain that bullish bias on the Japan 225. First resistance level it got to surpass will be at 45,960. So only a breakout above 45,960 will signal the start of a fresh impulsive up move sequence. Looking up for the next resistance to come in near term at 46,430, 46,580. So that's for the Japan 225. However, a bearish breakdown below 45,000 short-term pivotal support level will invalidate the bullish bias view to kickstart another round of minor corrective decline as it continues to mean revert towards the downside, towards the rising 20-day moving average, with the next two support level to watch at 44,560. Below it exposes 44,050, which confluence with the rising 20-day moving average. So that's for the Japan 225. Next up will be the Germany 30 representing the German DAX over here. So the Germany 30, we do have a bullish bias. So the bullish bias hit the 20-day moving average and that zone, the lower limit of that immediate the resistance zone that we highlighted on Wednesday, which is 23,735, 23,790. So it hit 23,735 on Wednesday, and on Thursday as well it tested, but it can't maintain the momentum and it plunges all the way down to revisit the swing low of 17th of September. All right, over here. So it seems to be that it's now trading in this minor sideways range configuration that has been taking shape since 17th of September and 19th of September. So this is a kind of about 1 week plus of minor sideways range configuration. So given that it's now at the lower limit of this minor sideways range, so I'll be watching the lower limit of this minor sideways range, which is my pivotal support for today at 23,390 / 23,310. Do have a mild bullish bias, pardon me, to push it up towards the top of this minor range configuration at 23,735, 23,790. So only a bullish breakout above 23,790, potentially exit out from this minor range configuration for the next resistance to come in at 23,900 and 24,090, 24,155. However, a bearish breakdown below 23,310 will start to see the continuation of this medium term. So that means this slide over here since the all-time high of 10th of July. Okay, so this is a 10th of July all-time high, will potentially transform into a further corrective down move again to revisit the 19th of June swing low area. All right, that means back down towards this 19th of June. That means the further extension of this corrective decline. Next support level will be at 23,180, then 23,025, which is very critical. So this is the minor swing low of 19th of June over here. So if you start to see a breakdown below 23,025, then this whole entire move, okay, since the fresh all-time high 10th of July may take a form of a double top, a kind of a major double top configuration, and this 23,025 also coming very closely to converging very soon with the rising 200-day key moving average as well. All right, so this is the Germany 30, okay, on the key levels to look out for. Next up will be the major US stock indices, starting with the US Wall Street 30. So US Wall Street 30, yes, it managed to squeeze down below our Titan short-term pivotal support at the 46,080 level, which I highlighted earlier on, 46,090, 46,080. Squeezed down, but the way it's squeezed down over here managed to find support at the rising 20-day moving average, very similar to the SPX cash stock index that I shared with you earlier at the start of the daily dose. And what's interesting over here is that upon hitting the 20-day moving average, it exits from the oversold level. So after upon exiting from the oversold level, it starts to flash out a bullish divergence. Okay, whereas the price action show a lower low. Okay, so with this bullish divergence, it represents that yesterday's sell-off is the downside momentum that starts to ease off. So I'll be using this pivotal support level here, watching very closely. So this will be my also very close to 20-day moving average, and as well as this former minor ascending triangle range resistance that was taken out on the 11th of September, retested on the 16th of September, now turns into a critical pullback support area. So it'll be at 45,780, 45,690. So this will be my pivotal support zone that I watch for today. Still maintain that bullish bias for a potential minor recovery on the US Wall Street 30. First resistance level to watch will be 46,280. Only a breakout above 46,280 will increase the odds of this recovery to retest 46,570 in the first step over here. However, a bearish breakdown below 45,690 will invalidate this minor recovery view scenario for the corrective decline to extend further towards the downside. Next support level to watch, 45,425, 45,290, 45,175, which confluence with the rising 50-day moving average. Next up will be the US Wall Street. Next up will be the SPX 500, pardon me. So on the SPX 500, the SPX 500 also plunges down, hitting that 20-day moving average as well. So I'll be using this 20-day moving average as my short-term pivotal support level for today, in view of a potential minor recovery as well. pivotal support level 6,580, 6,560 level. First resistance level to watch 6,635, followed by 6,670, pardon me, 6,680 level. However, a bearish breakdown below 6,560 will negate this recovery view to see a further slide to test the medium-term ascending channel from the low of 23rd of May 2025 at 6,530, we saw the minor congestion area of 5th of September to 11th of September. A breakdown below 6,530 will see a deeper minor corrective pullback unfolding to expose 6,460 next, which confluence with the rising 50-day moving average. So that's for the SPX 500. Watching very closely the rising 20-day moving average, which confluence with our pivotal support zone for today. Short term at 6,580, 6,580, 6,560 for a potential minor recovery. Lastly will be the Nasdaq 100. So the Nasdaq 100 also plunges as well. Hasn't really hit the 20-day moving average yet. A bit of room more to go. So I'll be watching this 20-day moving average at 24,140, 24,050 over here. So this will be my short-term pivotal support zone for today. To potentially look out for a minor recovery as well. Intermediate resistance level to watch will be at 24,590 for today, followed by 24,710. Only a bearish breakdown below 24,050 will invalidate this minor recovery view to seek out a more deeper corrective decline sequence to unfold, exposing the next support level at 23,840, followed by 23,700 that confluence with the rising 50-day moving average. So that's for the Nasdaq 100. Next up will be the commodities market, starting with the Gold XAU/USD. So Gold XAU/USD continues to help right above the after the test, a test again yesterday at the lower boundary of this ongoing minor ascending channel that is still in place since the low of 22nd of August, and also right above our first support level at 3,714, holding above our pivotal short-term support at 3,688. So as long as these two level holds, especially the 3,688, which is very important. So this will be my pivotal support level. So still remain bullish in any potential minor setback scenario. Given that price action continues to hold above this hold right at the minor ascending channel support after a retest of it again in today's Asia session. So as long as 3,688 short-term pivotal support holds for Gold XAU/USD, we'll still maintain that bullish bias. Upside trigger level for sure will be a clear bullish breakout above the current all-time high area here. So the current all-time high was at 3,791. Clear resistance level at 3,776 on the intermediate basis, where it got rejected on Wednesday. So a clear bullish breakout above 3,776 will increase the odds of a fresh bullish impulsive upward sequence unfolding in the first step to seek out the next intermediate resistance level at 3,820, 3,840 next, which is a Fibo extension cluster level. Only a bearish breakdown below 3,688 will invalidate this bullish bias view to see another choppy minor corrective decline unfolding towards 3,660/3,620, which is the minor swing low area of 11th of September and 10th of September that confluence with the rising 20-day moving average. Next up will be the very toppy West Texas crude oil over here. So for the West Texas crude oil, price action managed to squeeze up yesterday over here. So the squeeze up on this West Texas crude oil in yesterday was this due to this particular news flow where Russia decided to actually curb its exports of oil. All right, so over here, oil is set for the biggest weekly gain in 3 months as Russia cut fuel export. So that causes the WTI crude on the West Texas oil CFD to squeeze up above our pivotal resistance that we have earlier on at around the 64.90 area, and also above the 50-day moving average. So now it seems that it is about to do a more corrective rebound sequence taking shape towards the next resistance level at 66.20, followed by the medium-term resistance zone of 6690/6690/6720, which is the minor swing high area of 6th of August, and as well as this major descending trendline resistance drawn from the high of 28th of September 2023. key pivotal support level to maintain this more pronounced corrective rebound scenario playing out in West Texas oil potentially will be at 64.90/64.55, which was yesterday's minor swing low area. Only a breakdown below 64.55 will invalidate this bullish bias corrective rebound view to see a return of another choppy downward drift to retest the 20-day moving average, which confluence very closely to the minor swing low of 24th of September and 23rd of September at 63.70 next. Right, only a breakdown below 63.70 will see it mean reverting back down towards the range, minor range support of 5th of September at 62.15/61.85. So that's for West Texas oil. Also sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today's key data will be at the 8:30 p.m. Singapore time. Okay, pardon me, let me stretch it out over here again. Okay, let me go it down. Yeah, because during the European, before the release of the core PCE price index, right, in the European session, there's this public speech by ECB Governor President Lagarde at 5:30 p.m. Singapore time that may influence the euro dollar, the euro crosses, and as well as the Germany 30 CFD index. So something to look out for. Then for those who have interest in the dollar CAD and the CAD crosses, we have the monthly July GDP print out for July and August over here at 8:30 p.m. for Canada. That could influence the dollar CAD and the CAD crosses over here. And the most important data will be at the same time, 8:30 p.m. will be the core PCE price index, where the US Federal Reserve is watching much more closely because that is their preference gauge of inflation trend in the US rather than the CPI data. All right, over here. So for the month-on-month basis, market is expecting a slight dip down to 0.2% from 0.3% in the previous month of July. And market participants will be focusing more on the year-on-year basis one because that's removed off the seasonality factor, stretching out from a longer period. So from the year-on-year basis, the core PCE price index market is looking at almost unchanged from 2.9%. That was it as the same print from the previous month of July. And also two data that we're looking at is to gauge the demand side of the story on the US, the demand situation. Where it's personal spending and personal income, because that could influence retail sales side. That will be a demand side indicator. So that will also be monitored very closely by the market as well, because market now is expecting the personal income to dip down slightly to 0.3%. Personal spending to hold. So if personal spending and personal income starts to go down below expectation, whereas the PCE price index continues to help around what market is expecting, that could also potentially prompt an increase bet again. That means there could be the Fed funds futures traders could increase their Fed cut rate bets as well because of a weaker demand situation in the US if personal income and personal spending dip down what market is expecting at 0.3% and 0.5% respectively. And after the release of this core PCE data and the personal income and personal spending data for the US, which is important, we have Federal Reserve official speaking, 9 p.m. Fed banking, over Fed barking, which is speaking, and 1 a.m. Fed Bowman. All right, so Fed Bowman and barking tends to skew towards more of the dovish side. So it's very interesting to see here their public speeches right after the release of this bunch of key US economic data that the market participants are watching very closely over here. Then before we go, two more Federal Reserve officials speaking, Fed Musalam at 1:30 a.m. and 6 a.m. Singapore time. Fed Bostic is speaking over here. All right, so with that sum up today's Daily Dose of Market Insights. I'm Kelvin here, signing off. I wish you all a great day ahead and hopefully a restful weekend as well. And we shall speak again on next Monday. Thank you.